there's basically a stable relationship between money balances and economic activity. And the money supply, after inflation and after adjusted for the trend rate of increase in money and velocity, which is a purely cyclical variable. If consumers experience a surge in money defined as I just did, then they will shed the money balances. And in so doing, they will bid up spending and eventually prices. If money supply is below that trend, then they will have to build up their money balances. And to do so, they will have to reduce spending or reduce the prices that they're paying for goods and services. And so I believe that monetary policy is too restrictive for the economy to continue moving forward with a 2.5% inflation rate and positive economic growth unless the Federal Reserve reverses itself. Now, a lot of people will say, Lacy, you've ignored the fact that money supply and bank deposits and bank loans got stronger since last November. Yes, they did. Now, normally, I believe that money supply is controlled by Federal Reserve actions sufficiently, not perfectly, or it's a function of the exogenous role of the Fed. But there are instances when the actions of the banking system and its customers can exert an endogenous influence. And that's what happened since November. When firms went out and individuals in business went out to buy things in advance of tariffs, they had to pay for it. And they didn't have sufficient cash balances to do so. So what did they do? They went into the banks and they drew on their lines of credit. And in the case of the consumer and small business, the lines of credit are very expensive. And so what we witnessed beginning in late November is a fairly significant uptick in both sides of the bank balance sheet, loans and deposits. But this buy in advance is now being reversed. And in the last 2 or 3 weeks, we've actually seen the other deposit liabilities in nominal dollars fall about $18 billion. Not a small change. It's over a relatively short period of 2 to 3 weeks. But I think it's part and parcel of this reversal of the buy in advance policy that went into effect. And so money supply, the Fed is going to very quickly find out that it's much weaker than they think it is. To me, the critical exogenous variable is my modernized version of world dollar liquidity, which is the Fed's holdings of government and agency securities and also foreign official holdings of treasury. And it's the great leading indicator. Historically, world dollar liquidity grows at 10% per annum, and it's currently in negative territory. It's not as negative as it was at the worst point of the last couple of years, but it's still contracting, which tells me that this upturn that we saw during the front-running period is going to be reversed. If you think of your demand and supply curves in microeconomics, when you impose tariffs, the upward sloping supply curve lifts itself up and shifts inward toward the origin. As we know, the demand curve is downward sloping, so you're going to intersect at a higher price level. But the demand curve is upward sloping, so the quantity demanded is going to go down. Now, here is a little bit of economics that I hope people will check me out on. Most of the goods in international trade, what we call price elastic. In other words, there are a lot of substitutes for them. Virtually the only thing that has an inelastic demand curve is energy and a few types of drugs that are very essential for maintaining life. And when you have a price inelastic demand curve, it's a vertical line. So if you impose a tariff here, the producer is able to push the price increase fully through. But the more substitutes, the supply curve gets flatter and flatter. The flatter the supply curve, the greater is the percentage decline in quantity demanded. So quantity demanded, the percent change, is greater than the percent change in price. Well, price times quantity is total revenue for the producer. So in that environment, the total revenue of the firm goes down. When the total revenue of the firm goes down, the demand for the factors of production go down. Now, the factors of production are natural resources, capital, and labor. So the price increase from the shift in tariff goes into effect, but quantity demanded goes down, total revenues go down, and so does demand for natural resources, labor, and capital. And so the second, third, fourth, and fifth rounds are deflationary. And that was the case. The only way that would be different is if the Federal Reserve at the same time jumped in and massively increased the money supply and allowed the price increases to be absorbed. But that's not what the Fed is doing. They're sitting tight. The Fed likes to say that we are data dependent. We want to wait and see. In my opinion, there's no reason to be data dependent. In this environment, if the tariffs remain in effect, their ultimate impact is deflationary, not inflationary. And moreover, it comes at a time when money supply is also contracting. If you take M2, not ODL, and you put it on a 4-year moving average and you detrend for both money growth and velocity, and we have to use annual data because we don't have monthly data in the earlier time period, and you start it in 1914, which was the first full year of operations for the Federal Reserve, what you'll discover is that we are in the 9th contraction since 1914. Contraction number 2 was the one that led into the Great Depression. And all of the other contractions coincided with recessions. And real M2 on a detrended 4-year moving average is negative. And it's going to get more negative here as we go forward, in my opinion. My feeling is that if we're not in a recession now, we will be. It's kind of hard to have confidence when such a critical variable as payroll employment is so grotesquely overstated relative to the business employment dynamics, which is your full sample of 12 million firms. And keep in mind, when you overstate the job gains, then wage and salary compensation is overstated, personal income is overstated, gross domestic income is overstated. And if there's less wage and salary income and personal income, then it enforces the notion that one of the reasons we see these constant downward revision in consumer spending is that something called survivorship bias. Let's say there's 4 firms in a field and one of the firms fold. Well, at that point in time, the 3 remaining firms are going to pick up some of the 4th firm's business. And it could be in a declining overall environment. And a lot of retailers have gone out of business and a lot of others have retrenched. And so when you see a result coming out of the first quarter with this massive downward revision in real consumer spending, it's an indication that as you get more complete data and you minimize the survivorship bias, you get a truer picture. And so by focusing on things like payroll employment and GDP, you're working with theories that we don't really have confidence with and one shouldn't have confidence with because of the fact that they're so frequently revised and generally downward. We did get a very dramatic surge in vehicle sales there in the second half of March and it continued in April. But the Ward's automotive data that I've seen for the first half of May shows a major reversal, and the consumer spending indicators that I look at in the early part of May, the consumer spending picture, other than automobiles, looks weaker. I think the consumer is currently retrenching. And I personally am concerned because that enhances my own worries about the restrictiveness of monetary policy. My feeling is that it already warranted a cut, and I think that this year we'll see 4 cuts in the federal funds rate, 25 basis points cuts. Even though the Fed funds futures market is only allowing for 1 or 2, I don't keep track of what they're doing, but I think we're going to see the federal funds rate be cut more often and by a total amount much more than the consensus is looking for. That has been my view. I know it's been an unpopular view, and it doesn't appear to be moving to fruition, but I'm not going to change it. I think the facts warrant that I stick with it. I think they're going to become concerned about the economic outlook. Another thing, too, that I think that people need to be focused on, whenever you have a prolonged period of stability in markets and a lot of risky debt creation, there is an increasing risk of what people would call a Minsky moment. Now, a Minsky moment is very difficult to project. But there are 2 studies that I would recommend people read that have just recently come out. One is from the Boston Fed on the systemic risk to the banking system from their lending to the private credit sector, and a similar study from the IMF on this systemic risk that may link the banks to the private credit. Now, keep in mind that right now, the entire increase in bank lending over the last year has been to one sector net, and that is to the non-depository financial institutions, which is your private credit. Now, these folks right now have good credit ratings, but they are lending to very risky borrowers, and they're leveraging those loans. So the Boston Fed is saying there's a systemic risk. The IMF is saying there is a systemic risk. And there are a lot of instances in the past where we've seen similar types of behavior. And as Minsky said, stability leads to instability. Now, you can't predict that, but this pattern of systemic risk is something that has me concerned about. It's something that cannot be predicted, but it certainly, in my view, is in the system. feel that there is great value in the long treasury market. And I know that I've given that prediction before. The bond yield here is very close to 5. It's been above 5 briefly in a couple of instances. Every time we go above 5, we don't stay above 5 very long. The latest inflation measure is 2.4%. That includes the haywire measures of shelter, which are a huge component. A lot of serious concern that it's overstated. Excluding the shelter component, the inflation rate's only 1.5%. That's a huge differential between 5% and 1.5 or 2.5. And historically, those differentials between the bond yield and inflation have not lasted very long. They've created opportunities for investors, and that's one of the things that I can offer some opinion on, and I remain optimistic in spite of the fact that I have been overly optimistic. Historically, the taking on of debt is repressive through the law of diminishing returns and also because of the deadweight loss of the interest expense. What happens in some empires when they are debt overheavy, too much in interest expense, they do resort to money printing at the end. The money printing then just makes things worse. People always say, well, we can always inflate our way out. No, we cannot. We tried heavy money printing during the pandemic. And what happened? Inflation rate surged. And the tragedy of that inflationary surge during the pandemic and in 2021 and 2022 and early 2023 is that the burden fell most heavily on our modest and moderate income households. The majority of our people are heavily robbed by inflation. Virtually no one except most wealthy of us. They don't have the resources to protect themselves. And so when you get into these highly over-indebted situations, empires have tried to go the money printing route, and that occurs shortly before the violent end. But empires do not do well when they become extremely over-indebted. The great David Hume said in his famous paper of federal credit, written in 1752, the same year, he wrote of foreign trade and of money, 3 tremendous papers, just as valid today as they were then. He said, when a government has barred all of its future revenue, the society lapses into tranquility, languor, and impotence. And his policy recommendation for successful government was to always run budget surpluses so that when you have a national emergency, you don't have to go into debt to pay for it. And what have we done? Exactly the opposite. It was a real tragedy when in the early 1980s, the House and the Senate took up Milton Friedman's amendment to the Constitution that would have required a balanced budget except when there's a 60% vote. In other words, that precluded budget deficits without exceptional support. I think the budget deficits have been a major problem and will become an even greater problem because no one wants to deal with them. I mean, we have a new bill here, a budget bill, which in my opinion really doesn't affect the deficit to GDP ratio, but it doesn't solve the debt overhang. As these bills go, it's not bad, but it's not what's needed.